All right, so let me ask you a question. In the long run, which do you think would yield you a higher rate of return on your investment? Investing your money in the stock market or investing it in low-risk assets, such as treasury bonds? If you're like most people, you said, well, investing in the stock market, of course. And you'd be right. The fact that stock markets provide long-term returns that are greater than those on low-risk government bonds is well established and well accepted. According to one study conducted by iBots and Associates, for example, if you had invested $1 at the beginning of 1926 in a diversified portfolio of large company stocks, by the end of 2016, you would have had close to $12,000 compared to only $22 if you had instead invested in US Treasury bills. That is an annual return of 10.1% from investing in stocks compared to only 3.2% from investing in Treasury bills. That's a significant difference, isn't it? But it makes sense though, right? After all, investing in stocks is risky, and most of us are risk averse. We don't like risk, which means that we seek compensation for bearing risk. Much like we seek compensation for doing anything we don't like a hard day's work. Hence the age-old adage, high risk, high return. But what if I told you that between 1926 and 2016, if you calculate the monthly returns of all the stocks that are listed on the main US stock exchanges and then compare those returns to those earned by 1 month Treasury bills, which is practically a risk-free return you could have earned by lending your money to the US government for 1 month, you will find that more than half of the stocks earned less than what the Treasury bill did. In fact, most of these stocks didn't just earn less, they earned a negative monthly return. Moreover, if you calculate the returns earned by these stocks over their lifetime, you will find that only 42.6% of the stocks yielded a lifetime return that was more than what you could have earned had you invested in 1 month Treasury bills for the same amount of time. You will also find that more than 50% of the stocks yielded a negative lifetime return, with many of them yielding negative 100%. Yes, you would have lost all your money investing in them. Do you find that hard to believe? Well, if you don't believe me, read this research paper by Professor Hendrik Bessembinder. It's titled, Do Stocks Outperform Treasury Bills? And in this paper, Professor Bessembinder reports these very findings and then effectively says, no, most stocks do not. But how is that possible? How can it be that the overall stock market generates a return that is significantly more than what can be earned by investing in Treasury bills, and yet most stocks fail to do so? The answer, my dear friends, lies in the distribution of returns. It turns out that stock returns are positively skewed. What that means is that if you take all the stock returns and then sort them from lowest to highest, you will find that more than half of the returns are negative or modestly positive. But then towards the end, you have some exceptionally large positive returns. So that when you calculate the mean return across all the stocks, the mean is significantly positive because the large positive returns to a few stocks offset the modest or negative returns to the more typical stocks. If you think about it, at some level this makes sense. After all, the worst thing that can happen to your investment is that you lose all of it. That is, you make a return of negative 100%. But the highest possible return that you can make is, well, theoretically infinite. You can make 200%, 500%, even 10x or 1000% of your initial investment, especially if you hold it for a long period of time. That said, what is fascinating is the degree to which stock returns are positively skewed. In his research paper, Professor Bessembinder shows that between 1926 and 2016, just 5 companies, ExxonMobil, Microsoft, Apple, GE, and IBM, just these 5 companies created 10% of the total net wealth created by more than 25,000 companies. He further shows that 90 of these companies created more than 50% of the net wealth, and get this, the 1,092 top performing companies, which makes up for just a little over 4% of the total number of companies, are responsible for all of the net wealth created. That's right, all of it. So now, going back to the question that I asked you at the beginning of the video, which do you think would yield you a higher rate of return on your investment? Investing in the stock market or investing in government bonds? Well, if you're one of those people who can look at 100 stocks and can immediately tell which 4 to 5 will be the top performers, you'll certainly get a higher rate of return investing in the stock market. But if you, like most people, lack such knowledge or foresight, but nonetheless decide to hand-pick stocks based on whim, or some article you read, or some video you saw, or because your friend Greg told you to, well, the odds, quite literally, are that you'll miss investing in the top performers. So the implication is clear. If you are the average, unsophisticated investor, you may want to avoid hand-picking stocks and instead consider investing in a well-diversified portfolio, say by buying an ETF that tracks the S&P 500 or some other broad-based index. Because here is the punchline. If you don't diversify, you face the risk of failing to invest in those handful of stocks that, after the fact, generate large returns. Now, if you're an above average or somewhat sophisticated investor, actually, you may still want to consider investing in a well-diversified portfolio. Yes, it's certainly possible that you've seen some success in the past buying and selling stocks yourself, but there is a lot of research which shows that active investing strategies underperform relative to market-wide benchmarks more than half of the time. And finally, if you are that exceptional investor who tracks the news, reads the reports, analyzes the data, and can spot the winners from miles away before anyone else, I have 3 words for you. To the moon! More power to you, my friend. Please share the love, and in the comment section, tell me which stock you're investing in next. All the best in your investing journeys. This is Professor Ikram. Thanks for tuning in. If you found this video useful, click the like button and subscribe to the channel. And feel free to ask any questions using the comment section. Happy learning.